Mindset Show. Today we're going to be doing another subscriber request, this time on iRobot. So for those of you who may not know, iRobot's that little vacuum cleaner thingy majig that you can buy and it cleans your house. You know, there's different variations of it. There's the most expensive one that's like Wi-Fi connected. It's automated, does its own thing automatically. And then there's the other one that, you know, it's more simple. You know, you put it where you want, you turn it on, and it'll do its thing. So the added convenience of cleaning your home, that's what they're trying to tackle. And the company has had some interesting price action the last couple of, I guess you could say, well, we'll look at it together and kind of talk about it together, you know? So this is the 5-year chart. We take a look at the max. They had this period of strong performance coming out of the financial crisis. And you could see here, right here, you know, I remember back in 2017, this was considered like a winner. And a lot of people were, you know, very bullish on iRobot and the continued success, so to speak, of iRobot. Then they went through some turbulence going through here, right? The business had a little bit of a correction, you could say, you could call it that. And then seemingly had this bit of recovery when things, you know, looked better for the business. And then, of course, 2020 occurred, and then we had the roar up, and then now we're back down here. So for the most part, we've gone nowhere since 2016. And unless, you know, you were selling somehow at the top, but, you know, that's timing stuff. And that's, let's not kid ourselves, very difficult, not realistic. So taking a look at the 5-year again, yeah, we're seeing it's pretty much gone nowhere. It's actually down 1.21% over the past 5 years. So the question is, after this price action, is the business, are the fundamentals changing? Is the price right now compelling to add to our portfolio or to consider to add to our portfolio? Well, first, we got to discuss a little bit about the business. I gave you the very basic overlay of the business and what it does when it sells these little machines that, you know, clean your house. So the original founding of this business was centered around a couple MIT guys, from what I understand, and they're, you know, involved in artificial intelligence and stuff like that. So there's a lot of value that I'll add, and I'm not going to read this 162 slide thing. We're going to just skim through this. By the way, if you guys see that number and you're like, I'm not watching that, don't worry, I don't want to do that either. But the point, what I want to say here also before we begin is look at the title of the PowerPoint, supply chain fragility. So I already know what they're going to be talking about, and I'll explain in the accounting how we can kind of see this supply chain fragility manifesting itself in the numbers. And I'll say upfront and bluntly, they have been impacted significantly by the supply chain. So we'll get to that when we're there in the model, for example. But okay, so forward-looking statements, you know, the classic, whatever, iRobot, shareholder rewards, okay, CEO keynote. Let's kind of look at the business itself. So this is kind of the outlay of the business, kind of showing us like a little timeline. And this is like the new introduction of products. They've been making some acquisitions here and there, again, all centered around the main focal points of trying to make the home a little bit more convenient through these little robotics machines that can help us clean our homes. So you can see how they originally were designed, right? Not designed, but how the original creators were originally creating these little robots, but they don't look as nice. This is more comforting, more welcoming into the home, stuff like that. You know, this thing walking around probably be pretty terrifying to some people. I don't know. And then what they kind of showing here is, again, like another, I think the same, yeah, it's the same exact years. It's just a little bit different milestones is what they're calling it, right? And just different products that they're mentioning here. iRobot Genius, this is again, the new avenue which they're trying to take the business. Looks like they have this vacuum thing. I haven't seen that, to be honest. I'll actually see what that is. And yeah, the same thing. They're kind of just, remember, this is a sales presentation. And then this is still founder led, by the way. So actually, let's highlight that real quick. So it's good sometimes to see a founder led business because the founder has a different sentiment towards the business. It's like their child. They often will take a little good care of it. So like there's a lot of investors who look for founder led businesses specifically. All right. So then we have software. So they actually are building an integration with software. So this is kind of, you know, what we can think of like your cell phone. You can control their devices through your cell phone. And yeah, they're basically saying hardware was king, now software is king. So they're going to be making investments. Okay, so those are the things we have to think about. What's their moat? These are the questions that start to come to mind. Is it difficult to replicate this? Do you have a understanding of what their software is? Is it hard? Or do they have any advantage with information as far as the layout of someone's home? How does that play in? So those are things we can think about. Also, the budget to develop this going forward. Do you think their size is adequate enough for that? What's stopping, what the quote unquote Amazon effect from occurring? Okay. So Amazon creates Alexa driven robots that clean your house, right? Just throwing things out there. Okay. We know they have patents, etc. Segment share. All right, I'm going to probably skip through most of this because I think we're kind of getting the idea. So transactional, and then the long-term relation. Oh, this is actually important. Okay, so the transaction relationship, right? Or the transaction part is short-term. You buy the product and you're good to go. What they want is to build a relationship with the customer. Everyone wants to do that. Let's kind of think about how likely it is for that to happen. But you know what? A new question came to my mind. How often do you replace these vacuums? I think I have the same one that I bought a long time ago, about 4 years ago, and I haven't thought about replacing it yet. It still works perfectly fine. How often are people going to replace this? I don't know. All right. So this is kind of like the one that they want, right? They want to move into this. They want frequent customer contact, improve customer retention, and personalize the marketing. Okay. All fair and good. That's what they say. We'll see what happens. All right. These are their metrics that they're guiding for. I think it's really important that we kind of take a look at what management's trying to highlight that they can do. So this is the customer A, the non-connected customer. They get $250, gross margin 30%, working media intensity moderate. Okay, so what I understand from there is this is the two customers, right? And they're wanting to highlight that they're trying to get customer B, right? Customer A is good, all well and good. Customer B is the connected customer. So this is the one that's going to have a longer term relationship going back here, the relationship. This is more longer term. They can get more value out of the customer here, or they can also provide more value to the customer. You can think about it like that. And then what they want in the future, oh, look, subscription-based model. That's what they want. Everyone wants subscription-based model. That's the future. So yeah, we can kind of see this is their media, not their media, sorry, their retail partnerships, et cetera. Okay. And I think from here, let's actually go over to the model, because I think everything here is just going to be like highlighting what they have for the future. Oh, no, actually, this is important. Good thing I didn't stop. So they want to get into smart speakers, apparently, smart plugs and switches. So all these things, yes, they're there for the future. Air purifiers. So we can kind of look at this and think about the potential and who they're competing with. That actually gives us a really good idea. So home security, you can kind of think of Ring, Google, Amazon by extension, Apple as well. All of them are getting into it. Lawnmower is interesting. So lawnmower, they're gonna, that'd be interesting if they make one like that. Smart sprinklers, very good. I think this is possible, but it's all potential. And this is the $1 billion opportunity, by the way. So this is a $22 billion opportunity. If you guys were confused by that, this 21 means 21 billion. So in total, it's a 47 billion. And they're highlighting what they're in, right? They're in the vacuum, they're in the air purifier. These are all things that they could get into, and they're all huge opportunities. So basically they're saying we have hundreds of billions of dollars of opportunity. Well, that's cool. I want to see execution. I don't want to see potential. Remember, what separates a speculative investment from a core investment is that potential versus realization. How much of it is just potential? How much of it is just realization? Everything to a degree has potential, but it's how much of it is potential, right? So you could be looking at, for example, hypothetically, I hate doing this, but it's an overused example. You could be looking at the next Amazon, right? But is it actually executing, or is it just, oh, potentially it could be the next Amazon? that's the question you got to be honest with yourself about. And depending on your answer would justify it being a speculation or actual core investment. All right, with that being said, let's actually move over to the model. And I want to highlight some key parts here. So if we take a look at the cash flows, let me actually zoom out for everyone so we can all see it together. I hope this is not too small, but I'll be descriptive in case it's too small for you guys to see. So we look at the cash flows from operations. They've been declining quite drastically. And where I see the decline occurring is actually in, where is it? Inventories, change in inventories. There she is. All right, so inventories is a drastic change. And this is that supply chain mesh that we were talking about, okay? So supply chains that they're highlighting, remember the whole entire presentation is supply chain fragility, right? So with this change in inventory account, they're basically spending a lot of money on inventory, and that's actually marketably causing the cash flows to drop significantly. You also have change in accounts receivables, but change in accounts receivables, that's fine. It's the inventory that I wanted to highlight. So the cash flows are quite drastically low. And something you got to think about when companies are all right now saying that supply chain woes, stuff like that, you got to ask yourself whether or not that's valid or they're just blaming, you know, the boogeyman, right? In this case, it's a valid concern for something like this because they actually produce a lot of their inventory by third parties in China. So when I was looking into that, there is room, and they are trying to improve that. Remember that the size of this business, it is about $1 billion business. So they don't have the scale that's something like, I don't know, you would think Apple has immediately to their fingertips that they can just command change and receive it. iRobot has to really work a little bit more for that. So I think we'll actually go to the ratios and start talking about those. But I think we'll be surprised, or at least I'll be surprised. I haven't checked these out, by the way. So this is actually going to be raw. And for what I see here is they got a good balance sheet. Current ratios adequately covered, right? So current liabilities are adequately covered by the current assets. Cash ratio, you know, that's the most aggressive liquidity ratio. So I'm not too concerned about that. This tells me they are not utilizing debt, fair, you know, healthy balance sheet. Total debt ratio, that's the total liabilities. So, but looking at debt, like actual money that they owe in terms of, you know, borrowing, if they're good. All right. And the gross profit margin. So this is concerning. This is a red flag. So declining significantly, that sometimes is indicative of lack of scale, or it could be telling me, remember, we try to derive a story from the numbers, not just simply read ratios. It could be telling me that they're having a lot of pressures from competition, low cost providers having to bring down their costs, or they're having uncontrollable costs, right? So it's one of the other, right? And I'm kind of probably leaning on it's a mixture of both, right? So they're having a trouble keeping costs low, but also fighting off competitors who are considered low cost competitors. And then we have operating margins. So operating margins were really good in 2020, but declined significantly in 2021. More or less, you could argue back to normal because it's 2017, 2018 levels. But it's kind of disappointing because it would have seemed that they made a lot of progress. And remember, let's actually go back now to the price action. And we can see in 2021, they had this pop because maybe the market thought, or people thought, investors thought it would remain, and instead it came right back down, right? So that's potentially what occurred. ROE, ROA, these are pretty good. The ROA could be better. Again, kind of declined almost by half, but the ROE is decent. Okay, so that's what I'll say about that. The earnings quality is really good. So that's a good sign. This is kind of measuring management, giving them a grade. The way we read this is 1 and above is good, below 1 is not good. So they had 1 year when it was not good. But for the most part, they're pretty good. All right, book value per share. We want to see how much of that is tangible book value and be realistic, because inventory is in there, and do we really want to count inventory? But you know, how do we know what real price they'll get for that inventory? All right. EPS, free cash flow per share. So they're generating more free cash flow. Oh, this is after the adjustments, by the way. I made adjustments to the free cash flow to kind of average out and blend it with what's basically what I might be one-time expenses. So when we get to the model, please keep that in mind. And then I'll actually pause and then come back and show you what it would be like if we had the cash flows as they are right now, including those inventories. Okay, so I'll show both. And then taking a look at the activity ratios, we kind of can get an idea of how they're moving inventory. So for the most part, nothing really stands out here. Things are pretty much the same, which is good. You know, it's not terrible. I mean, we can see that in 2018 and 2019, things got a little bit worse. And in 2020, they got better. And then they went back to normal in 2021. So I guess we'll go right to the summary report. And in the summary report, I already plugged in some numbers for us. And I put a 15% discount rate at a 20% growth rate. And that's the average. So then actually, let's actually put that at the high end. And then let's say they are going to grow less than that. So let's say first 15. Okay, so immediately we're getting very close to being priced for a 15% rate of return. They have been buying back shares, interestingly enough, on average over the past years. They can buy back more, but they're not. And I don't really want them to. I think they need to invest in that supply chain if I was, considering myself to be an investor. So let's actually assume some buybacks that they'll continue, but then let's keep them about the same level. So if they can maintain those buybacks at the current price with a 15% assumed growth rate, they're a buy. But let's see what happens if the growth rate declines substantially. And I think you guys already know based on, it's not there yet. And if you want a huge margin of safety, both in the growth rate and the discount rate, not just the discount rate, you want to assume they're going to grow at half that of what they were averaging out. You need to get this at $48, which is a little bit lower than where we are right now. Okay, so we need to see still a drawdown. And for those of you who've been watching the channel more recently, you guys know that we're going through somewhat of a little bit of a downturn, right? A downturn, but we've discussed some of the reasons. So you may yet get this company at a good price, but patience is key. And then again, what bucket would it fall in your portfolio? Would it fall in the speculative bucket or core holding? Or maybe you're this is something that's going to get acquired and we may never even get the chance. I don't know if anyone's interested in buying this as of now. They have been, interestingly enough, I know that they've been investing, yes, in their supply chain. And yeah, they've been doing some buybacks, but nothing crazy. Okay, so I think I'm going to pause here and I'm going to change the numbers back to where they were originally. And we're going to kind of see the little bit more of a bleak picture. This was the nice picture. The bleak picture is coming. All right, getting right back into it. This is actually what it looks like with the numbers as they stand right now. And you can kind of see here that that's why I normalize them. So before anyone thinks, I normalize them because clearly at basically any discount rate, this thing probably is not a buy. So even at a 10% discount rate. And that's if the supply chain has a meaningful impact for the longer term, that's a risk. So we identify that now. And I probably will stick my flag on that hill right there, that if supply chains do not fix themselves, if they're not able to fix those costs that they're going to incur, because those are real costs, real cash expenses on the business, then this is definitely going to see some more pain ahead. If they're going to fix it, then we can, think about that previous numbers that we had in the model, right? So that's kind of to think about. I did mention that we're going through a little bit of a downturn right now, and I didn't even show us the 1 day. On the 1 day, they're down about 6%. And then let's see on the 5 day. So something like this, they're only down actually 7%. So most of the pain was today. And for those of you know, I'm in cash or cash proxies, a lot of my portfolio. And I think now is the time that we're getting really excited to actually start deploying some of this cash and trying to pick out the companies that are, you know, on that buy list, on that good price, but we want to be picky in the ones what we add to the portfolio or end up adding to the portfolio. So for me personally, I don't think that this business will make it into my portfolio. I can see the appeal. However, I'm not entirely certain or have enough sufficient understanding in whether or not those supply chain woes will fix themselves for this company. I'll keep an eye on it. I'm going to put it to my watch list, and then I'm going to be watching this business. If, for example, it could get down to about like something crazy happens in the market and it gets down to $10, something crazy like that, I would reassess the business because maybe something terrible has happened, but I would reassess the business, and definitely that then it could probably be a core holding. But if I would say that would be an extreme example, let me be honest, but the price what I would start to get really interested in, if I do think the supply chains will fix themselves. And by the way, that $10 price was if I don't think they will, if I think there's going to be a huge confusion for the next decade in that avenue. But if I think, or I become confident that the supply chains will kind of fix themselves, or this business will fix it, I think that I'd be interested in about 30, 40, between that range. So starting from 40 down to 30, that could probably end up making it into the portfolio at that point, because I think at those prices, if I was confident in the supply chain, that's the if, then I think the margin of safety is sufficient at those levels. All right. So on that note, guys, if you guys have any other requests, go ahead and leave them down in the comments. This is going to be one of the two videos that will be released at the same time. The other one will be a more conceptual video, but actually more of an update on a business that was one of the cash proxies that ended up being a complete failure. So we'll talk about that and then what I'm doing with it. All right. On that note, guys, thank you guys for watching. Have a good one. Bye.